Hi there. You're listening to Market Matters, our market series here on JP Morgan's Making Sense podcast channel. I'm your host, Lee Price, from the FICC Market Structure and Liquidity Strategy team. In this episode, we're going to focus on the development of power trading, which aims to facilitate transactions between energy market participants. Power trading markets have grown in recent years and are gaining importance as the global push towards renewable energy production has changed the landscape for electricity generation. We'll start by exploring the evolving competitive dynamics in North American and European markets, and then examine some of the key factors driving the continued growth in power trading. To discuss these elements, I'm joined by my colleagues Chris Wu and Suvad Kapic, who are leading JP Morgan's power trading efforts in the US and Europe, respectively. Chris and Suvad, thanks for being on today.
Hi, Lee. It's great to be here.
Hi, Lee. Great to be here.
Gentlemen, I'm charged up about this discussion, so let's dive right in. When I think about energy trading over the past several years, price volatility is the first thing that comes to my mind. And if we think about energy price shocks, they're particularly notable in European power and gas markets beginning in late 2021 into 2022, with geopolitical and structural drivers to that. So if you think about the German base load 1 year forward as an example, today it's trading at around $90 per megawatt hour, but in its peak in August 2022, it hit $980. Since then, we've seen prices stabilize, which has been a positive in terms of facilitating meaningful growth and development in power and gas markets. Suvad, let's start with you here. How has the market evolved as prices have stabilized following the 2022 European energy crisis?
Well, traditionally and historically, the European market structure is one of a micro market structure and has historically also been organized more by countries, very local, physical nature, and of course of low storability as one of the definitions of electricity. Now, over the last 2 to 3 years, maybe even the last 5, the market has gained more dependency on the global gas markets, i.e. LNG, and also through the energy transition that we have seen became more volatile. The trading strategies and the products that we see in European electricity markets are some of time spreads, location spreads, and the search for a fair value. I would say that during 2023 and now into 2024, the market has become more liquid as certainty has grown over supply on LNG and gas markets. The 2022 and 2023 period of high volatility and uncertainty is over for the time being. And that's where we are right now.
Okay, thanks. That's helpful for context. And so you've mentioned structurally, we have this interconnected complex where electricity is distributed across the continent. We're seeing more variety in the ways to trade and an increased investor interest in energy markets. And as a result, trading volumes have surged in global power markets, particularly in European power derivatives, which have experienced triple-digit growth year over year. The surge in power futures trading would indicate a shift in the competitive landscape as institutional investors and trading firms seek exposure to these markets. Let's go a little bit deeper into that trend. So, Suvad, can you comment on the changes in competitive dynamics we have seen and whether you think that power and gas markets are becoming more financial over time?
Volatility in the financial world attracts various set of players in all the markets. And so it is the case in electricity markets or in Euro energy markets as well. So we've seen a influx of institutional investors, but also macro and equity investors over the last 2 to 5 years. We have seen increased interest of having exposure to European energy markets. And of course, the 2 major exchanges that we have in Europe, which is ICE and EEX, serve a full set of products which those players and companies can use to gain exposure to those markets. And I would say that the reason is not only the volatility, but also over years, the physical underlying of hedging power in Europe basically has gone away a little bit as we have less and less baseload capacity. So we have less nuclear capacity, we have less coal and lignite to be hedged over years. Hence, the traditional players, which are the physical players, be it the utilities and producers, they are less and less active in the market, and hence someone needs to fill the gap. So that's why we see a bit more of the institutional investors and hedge funds coming in.
Makes sense. Thanks, Suvad. And so you mentioned, okay, that there's volatility. Usually with that, there's revenue potential there. And so we've got this shift where it seems like sophisticated market participants have ramped up their energy trading desks to take advantage of that. And I think this build out of platforms is actually a trend that's taking place across a number of commodity markets. So we have, competitive intensity building in commodity markets. Chris, I haven't forgotten about you over there. Turning our attention to North American markets, the electric grid is split among independent system operators, or ISOs, and regional transmission organizations, or RTOs, which facilitate transmission among wholesale market participants. Be oversimplifying a bit, but ISOs are responsible for maintaining reliability within their area, kind of essentially keeping the lights on at the lowest possible price. Chris, we've mentioned that power and gas markets can be volatile and illiquid, which can lead to supply and demand imbalances. From your perspective in the US, what makes power markets unique? Are there any comparisons we can make to other commodities markets?
Yeah, thanks, Leland. So the US is a bit unique in the sense that within just the lower 48 state borders, we have approximately 7 ISOs, and then we have these regional transmission areas which are traded purely physically with very low liquidity in financial contracts. So from the ISO perspective, we have a group of Northeast markets that start with the New England ISO, the New York ISO, PJM ISO, and MISO. And then, of course, we have Texas, which is ERCOT. And then we have California, which is the California ISO. And then we have SPP, which started off as being mainly an Oklahoma ISO, and then kind of now has grown into the Rockies to include parts of like Colorado and Utah and those areas. What I would say is that this system in the US has made regional power prices extremely different and dislocated across the country. And then I think from an actual power perspective, the main difference in power that is similar for the US market as it is for the European markets, any markets I think that I've seen across the globe, is that in a ISO, where you have a third-party system operator that dictates the efficiency of the system, they're also the ones who generate ultimately the settlement prices that are linked to all of these physical contracts and financial contracts. And I don't know of any other commodity in the world that has an algorithm from a third party that spits out prices that ultimately the market settles as values of those financial contracts. So I think that is a very unique system.
Great. Thanks, Chris. And it sounds like unique is the right word in terms of the differences in having this niche kind of market within commodity space. And we've kind of touched on some of the differences and similarities between European and US power markets, which are very interesting. Then the market structure team, we've been tracking the continued progression of electronic trading and on-screen trading across various asset classes. And certainly this applies to energy markets as well. Specifically, if you think about the growth of streaming liquidity, which is evident in natural gas derivatives. And at JP Morgan, we have seen the development of new solutions for automated and low-touch energy trading. These themes are also evident in electronic power markets. Suvad, how do you see technological advancements in trading being incorporated into power and gas markets from your side?
Yeah, Lee, I think, what we've seen over the last years, and that's been with the addition of hedge funds, institutional investors, we've seen much more algorithmic trading in European power along each of those markets and across the whole curve pretty much, right? Whether it be intraday, so the cash price, basically real-time trading, or even day ahead till the calendar years out. We have on both exchanges algorithmic trading basically on gas, power, emissions. So that has changed the landscape in a way that if you compare it to 5, 10, 15 years ago, when utilities and typical physical market players have left the space open for financial players to come in, they have taken up the space. And with the volatility that we have explained before in this market, we've seen much more of this algorithmic trading. I think it's going to be probably for foreseeable future with us.
And how about in the US, Chris?
Yeah, and just to jump in there, we have seen a little bit more action, in particular in the PJM independent operating system. That system includes 13 states in the East. It is the most liquid market in the US, but we don't see that throughout the entire curve. We see that primarily in the intraday trading, next day trading, and a little bit in the next month contracts. So we haven't really gotten there yet in terms of a massive amount of liquidity across the curve in algorithmic trading. And a part of that just has to do with the fact that we don't have a lot of liquidity in most of these trading markets.
Okay, very interesting. So we've got some key differences there in terms of the development, kind of the use or embrace of technology there. And so at this point, we've outlined some of the changing competitive dynamics and the tools that are being used by market participants. We've mentioned that there are several reasons that energy and power markets in particular have become attractive for investors. Let's explore those opportunities in a bit more detail here. The European Commission recently announced several milestones related to the renewable energy transition and resilience, including reducing natural gas consumption, producing more electricity from wind and solar than from gas, and rapidly increasing renewable energy installation. Suvad, when you think about some of the major macro themes like geopolitical uncertainty or the green energy movement, how are these various forces impacted supply and demand dynamics in the power market?
We have the energy transition in Europe. We have it globally as well. This comes with the volatility that we talk about every day pretty much. And it is, I would say, just the sheer dependency that we have for the global gas markets nowadays make it so uncertain. With the loss of piped gas capacities into Europe, we became very much dependent on a product that is very volatile. So basically LNG. It's volatile. It's not as flexible as piped gas. We have quite a few competitors across the globe, be it Asia, South America, even Africa. So we're competing globally for a product that is not always readily available and as quickly available as we would need it. We still have to remember that the current energy system that we're using has been built over 50, 60, or maybe even 100 years, right? Changing it in a very short time period is very difficult. And to frame it up in one word, I think it's about stability, because the industry and the economy itself needs stability, and we need to be able to plan for the future. And this is what's very difficult in a dynamic supply and demand world that we are right now in.
Right. Okay. Thanks. And Chris, I'm going to give you a chance to add anything from a North American perspective, but you've heard Suvad talk about stability. And when you think about some of these renewable energy sources, such as hydro, wind, or solar, a stability concern there in terms of the power grid.
Yeah, absolutely, Lee. Look, I think the entire European and US complex right now, from just a pure power perspective, are dealing with exactly the same issues, right? Renewable energy sources without the storage capability is by definition an unstable source of power generation, especially in places where wind is the predominant renewable resource. Now, solar, though it is stable for 90% of the year, it will only happen in those midday hours. We know that we need power throughout the day. Solar on its own, even solar plus wind, is not a solution to stability. Stability in turn produces economic success and development and growth. And without that, it is going to be very difficult. The AI story, for instance, right? The AI story will never take shape if we don't have a stable grid. Now, what I would say for the US that is much different than Europe is exactly that gas comment that Suvad had made. We still do have probably the most stable natural gas production in the world, and that has benefited us greatly. We also have an issue where every single state right now is essentially acting on its own when it comes to energy policy, right? And that is going to make things very difficult, especially when you look at independent system operators that span across multiple states. That system operator needs every single state within that area to come together and work together. And that has become more and more difficult in the past decade. And I think that's where a lot of the instability lies. And then ultimately, I do think that even the separation of how demand is built and how supply is built alongside of that, it is not a very parallel system. And I think those two things need to come together in order to really develop out the grid. And then just another final comment about Suvad's comment about how the grid is extremely old in Europe. That is also the case in the US, right? These hydro plants, these nuke plants, a lot of the gas plants, and the transmission system, I would say half of these things are over 30, 35 years old. And they do consistently break down, and we do not really replace them. So as time goes by, if what you have right now in base load and in transport, if that really starts to break down, it's going to require not just a lot of dollars, but a lot of different entities coming together to really fix the grid.
Wow. So a lot of factors at play. It seems like additional infrastructure will be required in the near term from what I'm hearing from both you guys. And to add another wrinkle to that, we have the emergence of AI. So, within the market structure team, we've been focused on the various ways that advancements in artificial intelligence are reshaping trading tools and strategies. And subsequently, kind of alongside that, policy proposals designed to provide guidelines or guardrails in terms of AI use. But AI is transformational across industries, and the investments being made in AI technologies figure to significantly increase the consumption and demand of electricity. Extremely impactful theme in energy markets, but obviously something that is hard to measure or quantify at this point. Chris, there seems to be no debate that power demand and consumption will continue to grow. How significant of a role do you think AI will play in the evolution of power markets?
I think that the development of whether it's AI, whether it's other uses of the chips through technology companies, I think that the load growth from that perspective in data centers, like you said, I don't think there's really an argument against that, right? And I think one of the very easiest things to point out is that every single one of the largest tech companies in the world have pointed out that AI is the future and that their equity prices, they depend on whether that picture plays out or not, right? So I don't think that that is a debate. But that's only one avenue of load growth, right? I think if you look at the deglobalization across the world, you're also looking at a return to industrial load in the US, right? You've seen actually a fairly large amount of growth over the past 5 years, ever since COVID, from the industrial sector. There's also very simple creature comforts, even in many parts in the US that have not been electrified. For instance, heating demand in the Northeast, cooling demand on the West Coast. There is a lot of places that energy demand can come from in the next 5, 10, 15, 20 years.
There has been a global regulatory focus on energy markets this year. On May 13th, the U.S. Federal Energy Regulatory Commission approved policy updates designed to speed up the funding of new interregional lines to facilitate clean power transmission. Do you anticipate that we'll continue to see policy actions designed to grease the wheels of transition projects, so to speak?
On the policy front, if you look at a place like Texas, for instance, Texas is definitely trying to facilitate, especially new supply, in turn, sort of attract data centers and all these other large load to the area. Texas is now, they've put up $5 billion for new gas builds. That has not happened in other parts of the country to a large scale, right? So we've seen small individuals, for instance, a Southern company or a Tennessee Valley Authority, who have identified that data centers and growth from industrialization is going to require them to build new gas. But they also don't have sort of a federal or local funding in order to do that, right? So they have to figure out how do they monetize and how can they build that so that their shareholders and the company actually make money. Even the clean energy transition, right? They're not actually done from the system operator level, right? Who controls the efficiency in the system. In Europe, it's a little bit different because one country is essentially one system operator of its own. You can build wind or solar in a pocket somewhere, and yet it all still sort of adds to the supply demand stack of that actual area. But that does not happen in the US. Not enough.
Okay, so dynamics that we'll definitely be keeping an eye on. In Europe, we've been tracking the implementation of energy market guardrails as part of EU's REMIT 2 regulatory framework. Suvad, anything to add on that in terms of, REMIT 2 and its ability to bring additional transparency to energy markets?
Yeah, I think in general, we have to say that the European power and gas markets have always been very transparent, I would say. We have had REMIT in place for many years, and I think the transparency across the transmission system operators across the trading venues, basically the exchanges, has been always very high. And this is probably one of the reasons as well that we have so many players in this market, and that the liquidity, if I understand Chris fully, is probably even higher than in the US.
Thanks, Suvad. So differences in the transparency landscapes between North America versus Europe there. So we've touched on a lot. It's a growing market. We've got a changing competitive landscape, capacity constraints, emerging trends in terms of technology, the energy transition, and then also the regulatory landscape, which is developing over time. Very interesting. I think we've covered a lot of ground. It'll be fascinating to monitor the continued evolution of this market. Thanks so much for joining, guys.
Thanks for having us.
Thanks, Lee.
And to our listeners, stay tuned for more FICC market structure and liquidity strategy content on JP Morgan's Making Sense podcast. Until next time.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube.